This press conference is special because it marks the 100th meeting of the Monetary Policy Committee since November 2002, when the first meeting was held. It's also special because this is the first time we are doing or holding an in-person MPC press conference in over a year. I think before we get on with the business of the day, permit me to make a few acknowledgements. The story of how far the Bank of Ghana has progressed regarding the reforms to its monetary policy framework, following a sustained period of macroeconomic imbalances characterized by high and volatile inflation. I'm sure most of you would recollect when the bank shifted away from the monetary targeting framework at the time to the new inflation targeting framework, which we think has delivered in allowing us to be able to bring inflation down to the single-digit levels. Let me acknowledge Governor Paul Akwa, who took the initial steps in putting into place the institutional arrangements to support the inflation targeting framework in 2001. Other governors who followed, Governor Emisa Arthur, Governor Wampa, Governor Ishahaku, all of who contributed to deepen the institutional, operational, and accountability processes underlying the IT regime. Today, we are confident that these efforts have paid off, and the bank is in a better position to deepen the processes in line with the best international practices. The MPC met last week to deliberate on recent global and domestic developments and assess the risks to inflation and the growth outlook. Below is a summary of the developments and key considerations that the committee deliberated on to arrive at a decision on where to position the monetary policy rate. Since the last meeting in March 2021, global growth momentum has strengthened, underpinned by the continued policy support, mass vaccinations, and relaxations of restrictions, especially in the advanced economies. These efforts have helped to improve prospects of a rebound in economic activity, and which has been reflected in the revised IMF April 21 global growth projections to 6%, up from 5.5% in January 2021 projections. Nonetheless, the continued spread of the virus in parts of the world, the emergence of new variants, and the stalled vaccination efforts across emerging market and developing economies is continuing to cloud efforts at fighting the pandemic and thereby creating some uncertainty which could undermine the global recovery efforts. Global financing conditions remain broadly supportive of the recovery process. The persistence of low borrowing costs, declining long-term bond yields, and compressed sovereign bond spreads reflect the reaffirmation of accommodative monetary policy stance by the major central banks. Also, equity markets have strengthened further, sustained by the continued policy support and optimism about global growth prospects, while portfolio flows to emerging market economies rebounded in April 2021. Market participants expect these favorable financing conditions to persist for some time. Global inflation pressures have risen in some advanced and emerging market economies, driven by the sharp rise in commodity prices, especially crude oil prices, and a combination of a surge in demand and supply constraints as economies reopen. Over the medium term, these pressures are projected to ease as the rebound in crude prices is moderated by the projected increase in production by OPEC Plus members beginning May 2021. In addition, the still sizable spare capacity and the significant slack in labor and product markets are expected to weigh in on underlying inflation. In emerging market and frontier economies, currency movements and COVID-related supply-side constraints are expected to continue to drive price movements. In the domestic economy, the recovery process from the pandemic gained some momentum, evidenced by the latest high-frequency indicators. The bank's updated composite index of economic activity registered a strong annual growth of 26.8% in March 2021 compared to a contraction by 1.9% in the corresponding period of 2020. The key drivers of economic activity during the period were domestic consumption, prodded by VAT collections, construction activities, international trading activities, resumption of industrial production activities, and air passenger arrivals. The latest Ghana Purchases Managers Index, which gauges the rate of inventory accumulation by managers of private sector firms and measures dynamics in economic activity, also improved in April 2021. However, the bank's latest confidence surveys, conducted in April 2021, showed some dip in both consumer and business sentiments. Consumer confidence dipped slightly on account of recent increases in petroleum prices at the pump, new taxes, and transportation fares. In a similar direction, the optimism of businesses observed at the last MPC round also softened at this MPC on concerns that the imposition of new taxes and the ongoing electricity maintenance management program would adversely impact operational costs in the short term. Businesses, however, expressed optimism about their company and industry prospects. Recent price developments show that headline inflation dropped sharply from 10.3% in March 2021 to 8.5% in April, almost back to the pre-pandemic levels, and within the medium-term target band of 8 plus or minus 2%. The decline in the April inflation rate was driven by lower food prices and base drift effects. Food inflation dipped markedly to 6.5% in April from 8.8% in March, while non-food inflation rose to 10.2% from 10% over the same comparative period on account of increases in export prices and housing prices. Similar to the trends in headline inflation, underlying inflation pressures eased substantially in April 2021. The bank's core inflation measure, which excludes energy and utility, declined to 8.6% in April from 10.9% in March 2021. However, inflation expectations gauged from a survey of businesses, consumers, and the financial sector inched up in April, reflected in part sentiments again around the tax adjustments and the recent challenges in the power sector. Provisional data on budget execution for the first quarter of 2021 indicated an overall broad cash budget deficit of 2.6% of GDP against a target of 2.5% of GDP. The primary balance also recorded a deficit of 0.7% of GDP compared to a target deficit of 0.4% of GDP. Over the first quarter, total revenue and grants amounted to 12.8 billion Ghana cedis, which is 3% of GDP, lower than the projected 15.8 billion Ghana cedis, 3.7% of GDP. Total expenditures and arrears clearance amounted to 24.3 billion Ghana cedis, that is 5.6% of GDP, against the target of 26.5 billion Ghana cedis, 6.1% of GDP. Financing of the fiscal deficit in the first quarter was mainly from domestic sources, which pushed up the stock of public debt to 304.6 billion Ghana cedis at the end of March 2021, compared with 292.7 billion Ghana cedis at the end of December 2020. Of the total debt stock, domestic debt was 163.6 billion Ghana cedis, that is 37.7% of GDP, while the external debt was 141 billion Ghana cedis, that is 32.5% of GDP. Latest trends in monetary aggregates point to significant expansion in reserve money and sharp growth in broad money supply, reflecting the lingering effects of the liquidity injection and the COVID-related fiscal stimulus programs implemented last year. Reserve money increased by 32% in April 2021 compared with 21.7% in the corresponding period of 2020. Similarly, broad money M2 Plus grew by 25.8% relative to 16.8% over the same corresponding period of 2020. The increased M2 Plus growth was largely driven by the net domestic assets of the banking system. In terms of components, the observed expansion in M2 Plus was reflected in increased growth in currency outside banks and total deposits. Notwithstanding sluggishness in credit demand conditions due to the pandemic, the COVID-related regulatory reliefs and policy measures continue to support lending activities in the banking sector. From the beginning of the year to April 2021, new advances totaled 10.5 billion Ghana cedis, compared to 10.9 billion Ghana cedis for the same period in 2020. Total restructured loans executed by banks to cushion customers severely impacted by the pandemic stood at 4.65 billion Ghana cedis as at March 2021, representing some 9.8% of the industry's loan portfolio. On a year-on-year basis, annual growth in private sector credit as at April 2021 stood at 6.9%, compared with 17.9% in April 2020. Interest rates on government securities traded downwards across the maturity curve. The 91-day and the 182-day Treasury bill rates declined to 12.8% and 13.6% respectively in April 2021, compared with 14.1% and 14.3% respectively in April 2020. Similarly, the rate on the 364-day government instrument declined marginally to 16.5% from 16.7% over the same comparative period. Broadly, the yield on all the medium to long-term government debt instruments declined over the review period relative to the same period last year. The weighted average interbank rate declined to 13.6% from 14%, largely reflecting improved liquidity conditions on the interbank market. This translated into a marginal decline in average lending rates of banks to 12.9% in April 2021 compared to 22.4% recorded in the same period of 2020. The banking sector maintained its resilient performance through to end April 2021 with strong growth in assets, deposits, and investments. Total assets increased by 16.4% to 155.7 billion Ghana cedis. This reflected strong growth in investments in government securities by 34.9% to 73.3 billion Ghana cedis, funded by deposits and loan repayments. Total deposits recorded an annual growth of 24.2% to 104.9 billion Ghana cedis on the back of the strong liquidity flows from the fiscal stimulus and payments to contractors and depositors and clients of defunct SDIs. Overall, the impact of the pandemic on the industry's performance was moderate as banks remained liquid, profitable, and well capitalized. Financial soundness indicators remain strong, underpinned by improved solvency, liquidity, and profitability indicators. The industry's capital adequacy ratio of 21.8% as at the end of April 2021, was well above the regulatory minimum threshold of 11.5%. Core liquid assets to short-term liabilities was 24.9% in April 2021 relative to 30.1% in April 2020. Net interest income grew by 18.4% to 4.1 billion, compared to 18.8% over the same comparative period. Net fees and commissions grew stronger by 26.5% to 917.6 million Ghana cedis relative to 8.8% growth during the same period last year, reflecting a gradual recovery in trade, finance-related and other ancillary businesses of the banks. Accordingly, operating income rose by 16.8%, marginally higher than the corresponding growth rate of 15.2% a year ago. The banking sector deployed effective cost control measures, which resulted in a 1.7% growth in operating costs over the review period, significantly lower than the 17.8% growth for the same period in 2020. Loan loss provisions, however, increased by 29.4% compared with 7.1% a year ago on account of continued elevated credit risks. Profit before tax increased by 39.6% to 2.3 billion Ghana cedis, recovering from the marginal growth of 7.5% a year ago. Non-performing loans ratio increased marginally from 15% in April 2020 to 15.5% in April 2021, arising partly from the general pandemic-induced repayment challenges, as well as some bank-specific loan recovery challenges. On the external sector, the average prices of gold, cocoa, and crude oil traded mixed in the year to April 2021. Crude oil prices rebounded strongly and increased by 30% to settle at an average price of $65.3 per barrel compared to $55.3 per barrel in January, supported by production restraints from OPEC Plus and reopened economies as vaccinations expanded across most advanced countries. In contrast, gold prices declined by 5.3% to $1,760.7 per fine ounce on account of a stronger US dollar and rising US Treasury yields. Similarly, cocoa prices eased to $2,419.5 per ton in April 2021 compared to the $2,523.9 per ton in January. The decline in cocoa prices was attributed to increased supply in the Ivory Coast. These commodity price trends adversely impacted the trade balance. For the first 4 months of the year, total exports declined marginally by 0.2% year-on-year to $5,131 million, driven mainly by a 21% decline in the volume of gold exported, attributed to instability in the sector. Total imports, on the other hand, rose by $239.3 million to $4,372 million, supported by increased non-oil imports. As a result, the trade balance recorded a surplus of $759.1 million, that is 1.1% of GDP, compared with a surplus of $1,006.3 million, that is 1.4% of GDP in the same period of 2020. Gross international reserves stood at $10,990.3 million at the end of April 2021, providing cover for 5.1 months of imports of goods and services. The reserve level compares with a stock position of $8,624.4 million equivalent to 4.1 months of import cover, recorded at the end of December 2020. Cumulatively, the Ghana cedi appreciated by 0.5% against the US dollar in the year to April 2021, compared with a depreciation of 1.2% in the same period of 2020. The Ghana cedi also appreciated by 2.4% against the euro and depreciated by 0.6% against the pound sterling, compared with corresponding 1.4% and 3.7% appreciation over the same period in 2020. To summarize, continued policy support and increased optimism about the COVID-19 vaccinations has significantly improved the outlook and resulted in upward revisions of global growth projections. However, the lack of certainty about further waves of the pandemic with new variants and vaccination challenges, varying degrees of economic scarring and output losses, and limited fiscal space in emerging market economies, among others, may slow the global recovery process. Although global headline inflation has picked up due to the rebound in crude oil prices and supply constraints, underlying inflation remains subdued due to the sizable spare capacity and the significant slack in labor and product markets, providing some scope to maintain the accommodative monetary policy stance, but with an uncertain outlook. These global conditions, from the committee's perspective, would continue to support favorable financing conditions in the near term. On the domestic front, economic activities have picked up strongly, evidenced by the high-frequency economic indicators. Consumer and business confidence softened, triggered by the new revenue measures and recent instability in power supply, which coincided with the survey period. These have served to dampen sentiments, but are viewed as temporary and should improve in the near term. Private sector credit growth still remains below pre-pandemic levels, but we expect banks to respond to the observed emergence of increased demand for loans to support the expected pickup in economic activity. The banking sector remains sound and profitable, with adequate levels of capital and liquidity to withstand moderate to severe shocks. The industry has witnessed sustained growth in deposits, total assets, profits, and shareholder funds. The COVID-19 policy and regulatory response measures have somewhat helped to mute the effect of the pandemic on corporates and households and are being maintained in the near term. There are signs that the execution of the budget for the first 4 months point to some improved revenue collections and expenditure containment to ensure real realignment to the consolidation path. The fiscal data shows that fiscal revenues have significantly outpaced developments a year ago, but slightly lags behind target. The gap in revenue performance vis-à-vis the budgeted target has been somewhat compensated for by expenditure containment measures. However, in the near term, the committee noted the risks in the fiscal outlook surrounding wage settlements, energy IPP payments, the potential for arrears buildup, the potential for scaled-up expenditures associated with COVID-19, and mass vaccination efforts, and the implementation of the Ghana Cares program, which would have to be carefully managed in a time-consistent manner to minimize any deviation from the path of fiscal consolidation. On growth outlook, the committee's view was that the projected growth in the extractive industries, the steady rollout of the vaccination program and recovery in industry and the services sectors should work their way in supporting a faster closure of the output gap in the medium term. Headline inflation eased sharply to within the medium-term target band, driven mainly by lower food prices and base drift effects, a tight monetary policy stance, and stable exchange rate conditions. Since the initial shock to inflation in April 2020, the forecast showed that inflation will be close to the central target by June 2021. These forecasts remain broadly unchanged, and inflation would remain within the target band in the next quarter. Risks to the inflation outlook appear muted in the near term, but pressures from mostly rents and transport fares would require some monitoring to anchor inflation expectations. Under these circumstances, the committee decided to lower the monetary policy rate by 100 basis points to 13.5%. The committee will continue to monitor price developments closely and take appropriate action where necessary to contain all potential pressures in the inflation outlook. Thank you very much.